Hi, I'm Justin Zaks, Vice President of Strategy at Mumu Technologies. I'd like to welcome you all today to the second day of our inaugural three-day virtual event entitled Navigate Market Volatility with a Resilient Portfolio. There's a lot of uncertainty right now out there, and we put together a diverse program to help steer your portfolios in the right direction. Each day, we're going to be airing 3 different webinars, each 40 minutes long with a 10-minute break in between. Saturday's webinars will start at 10 a.m. Eastern, and Thursday's webinars yesterday are already available for replay in the live section of the Mumu community in the app. This event is going to give viewers an exclusive opportunity to learn about a variety of topics, including zero DTE options, ETFs, portfolio building, earnings season, U.S. elections, and how to use the Mumu app, along with many, many more. We'll be talking to a number of experts from SIBO, Wellington Management, BNY, Franklin Templeton, as well as a number of other leading financial professionals. Our first webinar of the day, How Does a Professional Fund Manager Build a Portfolio, features Gabe Kim, Portfolio Manager at Panda Fund 2, Eric Hertzfeld, President and Portfolio Manager at Thomas J. Hertzfeld Advisors, and David Neubert, CEO and CIO at Windshear Management and Portfolio Manager and Founder of Windshear Allocators Fund. Would you like to know how a professional builds portfolios and selects stocks? These 3 managers are going to give us an inside look into the world of professional money management and provide us with some tips so that you know how big of a position to build and then when to get in and out of trades. Please enter any of the questions for our managers into the chat and make sure to watch the entire webinar. We'll try to get to as many questions as we can in 40 minutes. If you do enjoy the webinar, please check out the live section of the app under the Discover Mu tab to sign up and set reminders for many of our more informative upcoming webinars. Let's dive right in. Welcome, everyone.
Thank you, Justin.
I'd like to have each of our guests introduce themselves and tell them, our audience, a little bit about them and their fund. We're going to start with Gabe.
Hey, Justin. Thanks a lot for the intro. And yeah, just by way of introduction, I got caught up in internet stocks during the dot-com boom. I invested a couple $1,000s into my first Panda fund and turned that into $1 million and used that to fund my parents' retirement. During the dot-com bust, I headed towards institutional money management for Wellington Management, where I helped various equity strategies, including one of my own, to outperform benchmarks. Recently, I've decided to launch Panda Fund 2. My goal here, like the first one, is to convert high-risk, high-return investment opportunities into exceptional returns by investing in companies where other investors hesitate. So that's my spiel.
Great. And how about you, Eric?
I'm Eric Hertzfeld, President of Thomas J. Hertzfeld Advisors. We're based in Miami Beach, Florida. We're a boutique investment manager. We run money in mainly 1940 Act companies. So these are closed-end funds, BDCs. We also have a hedge fund, which does institutional investments. So these are investment grade, direct lending, private credit type of strategies. Total assets is approaching about $1 billion. Beforehand, I was at JPMorgan for about 8 years, and I was based in Singapore and Tokyo and London, and I ran a foreign exchange correlation business, trading specifically with regard to making markets in the exotic derivatives market.
And David.
Hi, David Neubert, and I've been a professional trader mostly for large institutions like JPMorgan and Morgan Stanley for 34 years. And I've worked trading in Brazil and Sao Paulo, where we opened a bank back when interest rates were 2% per day. Quite exciting time. And also I've worked in London, Tokyo, Hong Kong, and New York as a professional trader. I used to run program trading and portfolio trading for Morgan Stanley globally, as well as all the automated computer-driven market making there. And now I'm running a hedge fund that's structured for individuals to both minimize taxes and maximize after-tax returns.
Well, thank you all for that. It's been really great to have you all on the show, and we're going to jump right into the questions. I know a lot of people are very interested in portfolio building among our clients. So how do you determine the right number and weighting of the different stocks when building a portfolio? And how do you view diversification? And I'll have anyone jump in here that might want to answer that.
Well, I'd say, well, first, my favorite topic is diversification. And there's a really famous saying I'm sure everyone on the panel knows it. It's diversification is the only free lunch on Wall Street, right? It's the only way you can make your portfolio less risky without affecting returns, and you don't have to pay for it. You just have to be diversified. Really, what matters in terms of the number of assets you pick, it really determines on what your goals are, what your risk tolerance is. So I think the answer is it depends. And we have a lot of people here, and it's nice because this group, I think, has three very distinct goals. We have somebody who's a lot of fixed income focused, somebody who's very concentrated, and then I'm very not concentrated. My goal, for example, is to keep my clients rich. And so I have hundreds of securities in my portfolio. I think let the other guys answer how many securities they have.
Thanks, Dave. I think when I was institutionally managing portfolios, my answer was similar to yours. But as I sort of I'm managing this high risk, high reward investment portfolio. I take more of the kind of the Warren Buffett approach to sort of invest in a few number of put a few eggs in the basket and watch the basket very closely, right? And so that's kind of how I'm thinking about it. And when I think about the overall allocation, I think my personal view is investors can do very well by sort of indexing to whatever index it is that they want to invest in.
How about you, Eric?
As David said, it really depends on the outcome, what you're trying to achieve. If you ask Elon Musk what his diversification strategy is, he'd probably look at you and say, I don't have one. I'm all in on everything I do. The problem with diversification in many respects is you're going to be a good diversified portfolio means you're going to be wrong on many things. And that's the idea. If you are always up and you're diversified, you're really not diversified. So I think the key thing is as David mentioned, if he has clients that are looking to stay rich and are rich, you have to diversify. It's not applicable to try to go for broke strategies. Now, a strategy that is really focusing on a very higher return, higher risk strategy as Gabe is running makes total sense to be not diversified. For our pension and institutional clients, we have to have a large amount of diversification. So I think it's really important to set forward what your goals are with each of your investments. But we tend to have about 30 or 40 positions for our higher net worth family office strategies. And for the institutional ones, it could be 2,000 or 3,000 diversified individual positions. So it's very, very high.
Yeah, and all of you bring up a very good point. It really comes down to the individual needs of the particular institution or the particular retail trader, and it's something to think about. Just because someone else is diversified a specific way doesn't mean that's going to be the best way for you to be diversified.
So for example, like if I were an individual investor and I knew I had a big pension plan sitting out there in the S&P 500 and the global index of all stocks and bonds in the world with 90% of my net worth, I could take 10% and bet on 3 stocks, right? But I would never take my whole net worth and bet it on 3 stocks, right?
Yeah.
And diversification, obviously gets into a little bit of my next question, and that's how do you think about and evaluate portfolio risk? Is it a dynamic process? And do you have any tips for our retail audience and how they might go about managing risk?
Sure, I can take that. The traditional approach, from David's and Gabe's background of having an institutional bend to it, you're using a value at risk type of analysis, which is basically looking forward of what the volatility is, trying to predict how for instance, David gave an example of 3 different stocks. Those 3 stocks may behave differently in a very quiet environment versus a very volatile environment. So on the institutional side, you're running your positions through models. You're determining what the efficient frontier looks. It tends to drop off around, depending on the volatility and depending on the correlation. Correlation is very important. If you're picking 3 stocks in AI, you're going to have a lot of risk, right? They're going to behave and treat a trend similarly to each other. If you're picking one stock in AI and one stock in healthcare, okay, you're getting some diversification. Now we're adding a stock that traditionally does well when a utility stock. So it really depends on exactly what stocks you're adding to the mix and what the outcome is you're looking for.
Great. Anyone else want to weigh on that question?
Eric, just kind of the way I'm thinking about it, in terms of risk. I mean, I can control the risk in each stock by kind of predetermining how much I'm willing to invest, right? So it's not that every single stock has 100% loss potential, but I think that it's a really good discipline just to sort of look at the investment and just be like, okay, I can't, if I put 20 grand into the stock, that's the most I can lose. And then it's really important to sort of stick to that discipline because, stocks go down. That's sometimes, emotionally that can be, perhaps a tempting opportunity, but it's just really important to just stick to that discipline. I can't lose what I don't put into the stock.
Yeah, and only thing I would add for individual investors is to remember that cash can be an offensive asset just as well as it can be a defensive asset in terms of your asset allocation. So one of the things that's quite classic, and everybody on this call knows this too, is that groups of baskets of securities will move randomly in normal times. And then when times get in crisis or something, they'll all move together, regardless of their valuation, regardless of their quality. And so you've got to be prepared for different scenarios. There's scenario one, say normal market, everything's bouncing around nicely. NVIDIA's up one day and Cisco's down that same day or whatever. And then you have days when there's a market crisis and everything moves together. And that's often what I've seen with individuals where they get in trouble is they'll be in a situation like that and they'll have leverage. They'll be borrowing money against a portfolio thinking they're diversified, and they are diversified except when the whole market moves the same way. And I'll give you an example from 2022. Stocks and bonds were always considered to be a nice hedge for one another. One went up while the other one went down, except in 2022 when the fear was about inflation. And during inflationary times, stocks and bonds move together. And during non-inflationary times, they move in opposite directions. So even what you think is diversified depends on the kind of market conditions you're in.
That's a really great point to bring up, that the conditions will change and your risk and your diversification will change along that. And I want to move on to the next question, and I want to incorporate one of our user questions into this question. So I wanted to know about what everyone's process is for finding and entering new positions. And we do have a user that's asking about dollar cost averaging. And do you use it? Do you not use it? Is this something that it's for institutions or not versus retail? So maybe incorporate that into your just general idea. How do you find a stock? How do you enter the position?
Well, I mean, I think it's really, finding a stock, I think is, it's art and science. I think it's really important in this market where there's a lot of passive money out there, which actually I think creates opportunities for active investors that are focused on that part of the market that isn't passive. But I think a lot of good ideas can be found on social media. There's a lot of great investment content on places like Reddit or Twitter, Moomoo, whatever it is. Like there's a lot of smart people out there with informed opinions, and it takes time to sort of figure out who's really knows what they're talking about, right? And but it's out there. You can find sort of informed views on companies that people have never really talked much about on CNBC or things like that, right? So I think social media is a great place to start, because if a lot of people are telling you it's an interesting idea and I've never heard of it, that's a really great place to start. And then just in terms of dollar cost averaging, my view on that is, when I start buying a stock, that's kind of when I know the least about it, right? And there's kind of an ownership experience, and for me, that's going to be a couple of years into owning a stock. And so I want to kind of make small, frequent purchases at the beginning. Oftentimes there might be some controversy, right? That's sort of there's a controversy there that sort of needs to get resolved, and so I want to sort of really add when there's controversy, especially when I feel like there's an edge, like where I have some analytical advantage that the rest of the market doesn't seem to be that focused on, right? Or is perhaps disagreeing with, right? So I'm a big believer of dollar cost averaging to get in, to get out. When I kind of assess how I've done in the past, my mistakes on the sell side have always been not selling enough fast enough, right? So, if I'm selling because the stock has gone up, that kind of takes care of itself. Everybody, clients are happy, I'm happy. But But if I'm not selling, you know, and the stock price is going down, it's, you know, when I look at it, it's almost always the case that I should have sold more quickly. So on the way out, there should be a little more urgency for me and the way I invest and the types of companies I invest in to just kind of sell more quickly. So not dollar cost average on the way out.
So I'm going to define dollar cost averaging just in case. Dollar cost averaging is where you take the same number of dollars, let's say, or whatever your currency is, $100 a month, and I'm going to buy $100 a month worth of Apple, no matter what the price is. So that means when it goes down, you're buying more shares. If it's up high, you're buying fewer shares, but it's the same number of dollars. So I will say that I think dollar cost averaging for individuals picking single stocks is an absolute no-go disaster. Don't ever do it, would be my advice. And the reason is, however, for portfolios, or if you're investing in a large, broad-based ETF or the entire market, it's a great way to keep yourself investing with discipline, and you're buying more as the market goes down. So you get to kind of hope for the market to go down so you can buy more. And the reason why I think it's a terrible idea for individuals with single stocks is that you'll sometimes get what's called a value trap. You'll get trapped in a stock that keeps going down. And if you dollar cost into a stock that goes to zero, you've lost all your money. Okay. An index or a broad market, very broad market, has never gone to zero to date, except maybe in a few wartime scenarios. In which case it's quite a much safer thing. You're not afraid of the whole thing going to zero. So dollar cost averaging makes more sense.
Yeah,
that would be the only advice I have.
I think David's point is very important to note. Dollar cost averaging for an unsophisticated investor could be very dangerous. It tends to
in individual stocks, you mean?
Correct.
Yeah.
Individual stocks,
yeah.
not indices. Indices, if you think about indices, they're consistently being rebalanced. So, you know, from a reweighting, a geometric weighting percent, you're getting a larger and larger position. Look at Google and Apple; they just keep getting, as they're going up, you're getting more and more. That actually, a lot of it goes back to a lot of the academic work on Kahneman Tversky's in terms of the risk utility function, and it gets very complicated. But suffice it to say, buying an index totally makes sense. Individual stocks. One of the things that I think comes to mind with just individual investors is, you know, maybe it's the fight's coming up and I'm thinking about Mike Tyson, but everybody has a plan until you get punched in the face. And what I see is a lot of times investors will buy stocks, and then, as David mentioned, they'll say, oh, it's gone down. And people say, oh, you can buy more. And you get very emotionally locked into stocks. I think the best plan to have is say, I'm going to buy these stocks. And if you do your dollar cost averaging with a plan, if you're saying, if either of these drop here, I'm going to buy. But conversely, if they go up, here's where I'm going to get out. Here's where I'm going to take profit. Here's my plan. If you have a very well-crafted plan, you can dabble into it, even though I know David said never, ever do it. I'll give you a little exception. I will say that if you have a plan, the problem is nobody ever follows the plan. So it's just like my fighter example. Everybody has a plan to duck and jive against Mike Tyson, but once you get punched in the face, you're not going to follow the plan. So then it goes back to what David said: don't do it. I recommend not doing it, unless you're sophisticated enough and you've lost enough money or made enough money to know. Once you put money to work and you start to put real money, you'll start to feel how difficult and uncomfortable it is to actually do the dollar cost averaging.
Yeah, well, I mean, many fund managers have specific rules that when they buy a stock, they will not put any more money in than, say, a certain percentage of their fund, even if it falls. And even though let's say they have a target of having a stock being 5% of their fund, the stock goes down by half, they still love the stock, absolutely love it. But now it's 2.5 because it's fallen by half. They will, all the good ones have rules that they just can't buy more even if they love it, because they already have their max in, right?
And I think that's the really important part that David made. And that was back to, like, you know, we worked at the same firm before, but many times we'll build in some comfort to say, okay, instead of the 5% position, we'll do a 2% position, knowing that we can get it to 5%. But once it gets to 5%, that's that. So, but it's a very sophisticated strategy, and I would avoid it.
Eric, your old saw beat mine, by the way. Everybody has a plan until they get punched in the face is way better than diversity is the only free lunch on Wall Street. So.
Sage advice from Mike Tyson.
Mike Tyson.
You know, who would have thought? And so moving on to the, the next part, speaking of getting punched in the face, I'd like to ask each of you, what is the hardest part about managing a portfolio? And maybe we'll start with David this time.
The hardest part about managing a portfolio is remaining disciplined, okay? And also interacting, dealing with, it depends whose money it is, right? So I'm dealing with other people's money, mine was in there as well, but it's trying to explain what you're doing to others. And often the process of explaining what I'm doing to others will sometimes dilute what is otherwise my disciplined plan, because people will say, why are you in this? Why are you in that? Why are you buying the stock that's down huge today? And everybody is saying anybody who owns it is an idiot. I'm like, that's exactly when I want it. Often is when everybody hates it. So I think that for me is the hardest part, is make that balance between your clients looking at what's in the portfolio and the discipline of staying in the portfolio, right?
Dave?
Yeah. I mean, wow, managing money is hard. I mean, I think everybody on this call recognizes, that to a certain degree or to a great degree. For me, I'm investing principally for myself and my family at this point with Panda Fund 2, and I'm comfortable, with 5 stocks in the portfolio, right? And so, with 5 stocks in the portfolio, I've got to watch those eggs very carefully. And stocks, no matter how much research I've done and how much confidence I have in the idea, I can be proven wrong tomorrow, and I have to be able to, I have to be one to sort of, take decisive action to sell it, right? And that has happened frequently, right? So, there's an emotional toll to investing. It looks easy, but it's actually a very hard thing. And this is a lonely business. When things don't work, even when things are working, it's hard, right? It's hard to generate excellent returns.
Yeah, that emotional part, I think, is overlooked so often, the emotional strain that can be put upon traders or portfolio managers, and affecting that decision-making process and having that plan and executing that plan. How about you, Eric?
I mean, I echo what David and Gabe said, but I mean, it's managing the stress, knowing, how to be, remain disciplined when things are against you adversely. And it's also about timing. And I think timing is one of the things that's least discussed. A lot of traders and day trader mentality is always feeling they have to be in the market. I have a good friend that runs a hedge fund. In 2008, in the beginning of 2008, he was going through a divorce. He closed down his fund and went to cash. He was in cash for 2008. He came back in 2009, the end of 2009, and he basically missed 2008. And he has one of the best hedge fund track records you ever seen in your life. It was just because he was a lucky. So lucky sometimes is, lucky is better than good. But I think the key thing is to not always feel that you have to have a position. If you don't feel like that your stocks right now is the right environment for it, I mean, we have an election right now. You can make a lot of money and lose a lot of money. But the important thing is just don't force it and just wait for the right pitch right down the middle, specifically if you're managing your own money. For institutional money, I think the challenge is really to always be, you can't just be in cash. Otherwise, they'll find another manager. So it's being able to make sure that you're diversified, as David mentioned, and keep the position on, even though you may not have as much conviction as you may otherwise have.
Yeah, that's a great point. The conviction is so important, and actually leads me into my next question for all of you, and that's about the outlook for the overall stock market in 2025. I want to get your thoughts and also your conviction levels, because I think right now there is a lot of uncertainty, both at the retail and institutional level, on what this election means, and what the Fed is going to do and where valuations are. So just want to get your overall view on the market from a valuations and earnings perspective, and maybe give us one of the biggest risks you see to 2025. And we'll start with Eric this time.
Oh man, this is the hard one.
I'm just switching up the order, Eric. It's a very random.
Yeah. Justin, listen, and this environment that we're in is incredibly, it's like a hit and run trading market. You wake up and you see the election results, and CVS stock is up 13% because of people are thinking that there's going to be less shrink. And then all of a sudden, 72 hours later, it's back down to where it started. It's a great market for very sophisticated traders that have a lot of discipline. But in terms of next year, look, I wouldn't have even thought we'd be up 25% in the S&P this year. Going into next year, I want to couch what I say, but our style of investing, as I introduced in the beginning of the call, we're doing much more in terms of credit work. So I'd rather the other panel take the questions in terms of the stock, but I would say we've already done a little bit over 50% in 3 years in the stock market. Could that continue? Of course it can, but I'm not as bullish as I have been.
So if I have to pick biggest risk that's out there, that first of all, I can't remember what the old software this one is, but it's always the risk that no one's identified, or that at least you haven't identified, that is the one that blows everything up. Okay, so nobody was, everybody that created a list at the end of 2019 of the greatest stock market risks for the next decade, and nobody had a pandemic on the list, right? So if I have to pick lists, I guess my known unknowns is, I would say the return of inflation is the thing that I'm actually betting on. Inflation historically doesn't come and go and then stay away. It tends to come in waves and keep building until there's some major economic shift. So that is what I think the biggest risk is. And I think in that risk, you end up in a world where all the diversification rules, or at least we call correlation rules, which is, correlation is just a fancy word for stuff moves together or not together, right? And you can kind of throw them out the window. So I'm actually, very much looking towards asset classes in the commodities area, or companies in the commodities area, as a potential hedge for what can go wrong, right? When you ask the question that way.
Yeah, and that's a great point. And I think a lot of people haven't seen inflation in a long time. And inflation itself, when it's high, can be more volatile, which can lead to volatile markets, which is something that people should be thinking about when this inflation does move that much. We just saw inflation sit, in very tight ranges for 15 years, and now we're seeing that might not be the case. So the possibility of it moving in either direction is much higher. And
it's like remain diversified even through something like that. So the worst thing that's happened is, everybody runs to gold at the same time and gets out of stocks. And then exactly that moment you should have run into stocks. So it's like, when I talk about adding commodities, it's adding a little diversification piece. It's not getting out of the stock market and the bond market to run in there, right? So,
and Gabe, what's your outlook?
Yeah, I think time in the market is kind of that's a key thing, right? Missing the top 5% of markets, you miss like 90% of the gains or something like that. It's right. So I tend to think about stocks from a bottom up perspective. When I think about the risks, I think there are two things since the election. I kind of notice a couple things, right? So I think the China stocks are down, right? The Chinese internet stocks are down, and then I think the solar stocks have really gotten killed, right? And so those are two things that could be, risks or opportunities. I went back and I looked at 2016 to 2020, the last time we had Trump, and it was terrible for sort of renewable energy type of stocks. But China stocks were actually pretty good, right? Like Alibaba or JD, whatever, like all these things were pretty good. And so I'm trying to figure out which one of these could be opportunities. I don't have any conclusions, but I think the thing I recall from Trump the first time around is, the market would really kind of latch onto what he said, the rhetoric, and then, the next day, he'd say something different, and all the gains would be evaporated, right? And so we're seeing some of that already with the Trump trade, just these past few days since the election. So I think what investors need to be prepared for is just more volatility. Just because we've got sort of a more interesting cast of characters, on the political side, and really just kind of do what I'm doing is I'm doing my research to try and build some confidence in both of these areas, and maybe there's a stock or two that I can buy in each of these areas, right? But really just kind of take this volatility as an opportunity, because I do think these are kind of stocks that are institutionally, they're kind of on the fringe, right? But I think this is really, these are areas where individual investors can really shine, because if I make an investment in First Solar and it goes to zero, I don't have to explain that to any clients really, other than myself, right? I'll have made a terrible investment, but at least, I'm able to make that investment, right? The only person I have to convince is at this point myself, right? And so I think that's sort of, an important element of, how I think about investing today.
Yeah, that's a great viewpoint. And so now we're going to move on and ask each of our guests a few individual questions based upon their own experience and their own fund. And we'll start with David. And David, I think our audience is really interested to learn a little bit more about quantitative investing, factor investing, this idea of growth versus value. Can you tell us a little bit about that?
So factor investing comes back to that concept of things moving together. Okay. So a lot of, and we'll all keep it in stocks, but it can apply to all investments, any security with a price that moves. But let's take about stocks. A factor would be something like stocks that are growing a lot or that have high PE multiples tend to move together more than the whole stock market moves together. And stocks with low PE multiples tend to move together. Another kind of factor is something everyone's quite familiar with is sectors. So oil stocks tend to move as a group based on news and based on oil prices, and technology stocks tend to move together, even though they're might be in quite different businesses. The kinds of investors that move in and out of them will move them together. There are factors like interest rate sensitivity. There are stocks like banks who move around when interest rates move around, but maybe technology stocks tend not to care about interest rates moving around. So each one of these things is a factor. So when we're building portfolios, we'll actually say what factors are we exposed to, which includes sectors, value. Big stocks are a factor and they move in their own world relative to small stocks. And as you can see, I'm describing so many different things that every stock can have many factors that push it around. But you also, when you have a portfolio of, I think, more than 20, all right, 10, even 12, you can start having factors affecting your portfolio. So you want to see, I think I'm betting on cheap companies, but I might actually just be betting on US companies relative to the rest of the world, or, or companies from one region. So I guess that's how we look at factor investing. It's another thing to diversify. Let's make sure I don't have all my eggs in one factor instead of one company.
All right, great. And another question we're getting a lot from our audience and wanted to get your viewpoint on is how things are shaping up post-election.
Just me or everybody?
Yeah, just you.
Okay, so post-election, it's created a kind of animal spirits. There's a lot of excitement around a reduction in regulation, a potential reduction in corporate income tax. And remember, corporations make and have available for distribution to their shareholders what's left over after they pay taxes. So a reduction in taxes is an immediate increase to profits, okay? Because the way corporations look at taxes, they're an expense. That is the excitement side, okay? The worry side is chaos, difficult to predict what's actually going to happen and who's going to be doing the enaction of policies. And so I guess those two factors are those two risk factors, right? Reduction in taxes on one side and chaos on the other side are sort of fighting to determine where we end up. So my outlook, like I said, my outlook is kind of leading towards inflation post-election. I feel like we would have this inflation pressure no matter who won the election, because neither party in the United States had any interest in reducing the deficit. And I think we're still in that case. So a lot of people are blaming the Trump who won, saying he's going to bring back all this inflation. But I kind of feel like it's going to happen naturally, no matter what. At least by then, we probably will be seeing it by the end of 2025, maybe 26.
All right, great. Thank you for that. And now we'll move on to Gabe, and we want to know from Gabe, what are your goals as a portfolio manager?
Well, I think it really depends on the objectives of the client, right? And so you've kind of heard three different viewpoints. In my world, I would say that when I was managing institutional portfolios, the goal was to beat the selected benchmark, right? And as managing my family's assets, my goal is to build wealth, right? And to do it in a way where I protect the downside by selling mistakes quickly.
That's great. And the other thing we kind of want to know is, you've run big money and now you're running relatively smaller fund. What are the differences there?
Well, I mean, you heard from our other guests, just the client, client reservations, right? Clients are wonderful because they provide the AUM, but on the other hand, they're difficult because they can be difficult when performance isn't as expected, right? So I would just say that relative to working at a large firm or managing a large fund, there are just fewer constraints, right? And I think very simply, the more constraints you put on a portfolio manager, the lower the alpha potential, right? The lower the potential to outperform. Now you heard that the other side of that though is when there's fewer constraints, sometimes investors can lose discipline or not adhere to a philosophy or process. So it's really important for everyone, including myself, to have a very clear investment philosophy and a process and execute it with discipline, right? And if you're not capable of doing that, then find somebody that you trust that can do that.
Great, thanks for that answer. And now we'll move on to Eric. And Eric, we want to ask you a little bit about closed-end funds and BDCs. Not all of our audience knows what those are. Maybe you can give us just a brief rundown.
Sure. So closed-end funds are one of the oldest investment opportunities. They predate mutual funds. Closed-end funds, there's about 500 of them, representing about 300 billion of assets trading on the New York Stock Exchange and NASDAQ. So you have all sorts of different, basically, they're like open-end mutual funds in that there's a active portfolio manager, but they're more akin to ETFs in that they trade on an exchange. So they're a little bit of a hybrid of both. And I think one of the things that's interesting about the closed-end funds is that you have a chance to buy assets at a discount, and that may be very interesting to many investors that run their own money because you have an underlying net asset value in terms of what the liquidation of this fund is worth, and then you have ability to buy it at discounts. So ETFs, conversely, have the ability to redeem and issue new shares, and that keeps the net asset value very close to the price. And there's arbitrageurs, big hedge funds that make sure that that's the case. But in our space, you tend to have discounts sometimes get 20, 30, 40% wide, and then also go to premium. So it's a nice space for individual investors to take a look at. And then the BDCs is basically the original direct lenders, if you will. These are companies that lend money to all sorts of different types of U.S. businesses, middle market loans. This is companies that are making $10 to $50 million of EBITDA, and the big complexes have been growing quite considerably. The market for closed-end funds, as I mentioned, is 300 billion, but in the market for BDCs and just private credit with BDCs inside of it is approaching this year almost 2.5 trillion. This is all of the private credit market. So this is about a 17-18% CAGR over the last 5 years. So private credit's probably, if you don't know about it, you probably heard people talk about it, and it's a very fast growing space.
Yeah, that's very interesting to hear about that. And what are some of the headwinds or tailwinds in the space, given the easing cycle and possible slowing growth?
Well, this is the most difficult thing to figure out, and I think as the panel discussed earlier, correlation. Everything becomes correlation one in extremes, right? So you have extremes being any type of crises or perceived crises, COVID, interest rate cycles in the 90s, obviously .coms in 2000. So I think the big thing that's been noticeable since the election has been correlation has been breaking down, right? Because you have lots of different sectors that are poised to grow and versus other sectors that are not. So for instance, we talked about healthcare, and we talked about just the appointments yesterday with Robert Kennedy Jr. I mean, you're having the healthcare stocks are looking, the Modernas and the Pfizers are looking very, vaccine stocks are going down, But then at the same time, you have, the stocks like, the AI stocks are going up. So this correlation provides a lot of challenges. I think it's going to be really interesting to see what the bond market does. So far I've spoken only about with regard to stocks. If we do have a scenario where what David suggested, which is really becoming a very nervous view, and it's been catching on. I mean, we've sold off from 10-year from 375 to 450 today. It's already starting to take place. And the real question is if that goes above 4.5 and starts to get in the 5s and 6s, what does that do for growth? What does that do for companies that have to borrow money? So you could have this environment where stagflation is a word that wasn't used up until about a month ago, and it's now roaring back. So I think it's really important to make sure that any investments that are made are really, have a really solid plan in case you have something that, that happens that you can't forecast.
Yeah, great answer. And unfortunately, that's all the time we're going to have for today. But, please, if any of you really liked what you saw from our 3 guests today, please let us know in the chat, and maybe we can have them back on again soon. There was so much I could probably go on for another hour with all these guests. And I want to thank everyone for being with us today and offering their views on so many great insights. I want to thank all our viewers as well for tuning in. Make sure to check out our special offers on the website if you're not already a Moomoo user. We're going to be back in about 10 minutes with our next webinar, Earnings Season Analysis and the Truth About Growth versus Value Stocks, with Christian Gallipoux, Senior Equity Market Strategist at Franklin Templeton Institute. Until then, stay tuned for a short video.
Worried a stock's price will go down right after you buy it? With Moomoo, you can check out the most updated short sale analysis before you trade. Find out how much a stock is being shorted and its short sale trend. Get a clearer understanding of the market and trade with greater confidence. Short sale analysis is free and exclusive on Moomoo. Download Moomoo now.
Too much research, too little time? What if you move smart? Invest smarter with Moomoo. Small gains, big efforts. What if you move smart? Invest smarter with Moomoo.
Everyone around me is talking about investing. Do you invest too?
Moomoo.
There's so much research to do, but so little time.
Moomoo.
But how do I actually start?
Download Moomoo.
Investing made easier. Download Moomoo now.
Moomoo has partnered with derivatives world leader Cboe, bringing you an options experience like never before. 5 major index options are now available to trade on Moomoo. Enjoy competitive pricing with zero commission, as well as zero contract fees for stock options. Inform your strategies with Moomoo's suite of free options features, including as many as 13 option strategies for you to choose, with their theoretical profit and loss analysis quickly revealed, as well as in-depth options chain, among many others. Experience pro-level tools by downloading Moomoo now.
Hello, Japan.
Hindsight sucks. It's all about foresight. When it comes to trading, you gotta get your calls right. Moomoo's the platform with AI intelligence, serving up insights based on customized relevance. Globally backed around the clock support. Pro-level features at a cost of naught. So let me ask you some questions that may seem curly. Would you rather work from dawn or retire early? Dream of getting on the ladder or buy a dream home, dance to someone else's tune? Or Moomoo your own?
Worried a stock's price will go down right after you buy it? With Moomoo, you can check out the most updated short sale analysis before you trade. Find out how much a stock is being shorted and its short sale trend. Get a clearer understanding of the market and trade with greater confidence. Short sale analysis is free and exclusive on Moomoo. Download Moomoo now.
Too much research, too little time? What if you move smart? Invest smarter with Moomoo. Small gains, big efforts. What if you move smart? Invest smarter with Moomoo.
Everyone around me is talking about investing. Do you invest too?
Moo.
There's so much research to do, but so little time.
Moo.
But how do I actually start?
Download Moo.
Investing made easier. Download Moo now.
Moomoo has partnered with derivatives world leader Cboe, bringing you an options experience like never before. 5 major index options are now available to trade on Moomoo. Enjoy competitive pricing with zero commission, as well as zero contract fees for stock options. Inform your strategies with Moomoo's suite of free options features, including as many as 13 option strategies for you to choose, with their theoretical profit and loss analysis quickly revealed, as well as in-depth options chain, among many others. Experience pro-level tools by downloading Moomoo now.
Hello, Japan.
Hindsight sucks. It's all about foresight. When it comes to trading, you gotta get your calls right. Moomoo's the platform with AI intelligence, serving up insights based on customized relevance. Globally backed around the clock support. Pro-level features at a cost of naught. So let me ask you some questions that may seem curly. Would you rather work from dawn or retire early? Dream of getting on the ladder or buy a dream home, dance to someone else's tune? Or Moomoo your own?